Most real estate investors think that material participation is about trying hard or being involved. That belief is exactly why the IRS disallows deductions, sometimes years after you've already taken them. Because material participation isn't about effort, intent, or ownership. It's about passing very specific IRS tests and being able to prove them. Although this does not just apply to real estate activities, this is one concept that can decide whether you save tens of thousands in taxes or lose every deduction you thought you had. Get this wrong, and you don't just lose a deduction, you invite audits, penalties, and back taxes. In this video, I'm breaking down what material participation actually means, the tests that matter, what doesn't count, and how to track it the right way. Make sure you watch to the end because this one rule can decide whether your real estate strategy works or collapses under an audit. Hi, I'm Sherry Ayland, and I help my clients pay zero taxes using real estate strategies from my Zero Tax Blueprint. To see if the Zero Tax Blueprint can work for you, click the link in the description. Material participation means you are actively and continuously involved in running an income-producing activity on a regular, continuous, and substantial basis. The IRS uses this concept to determine whether an activity is passive or non-passive. Remember, non-passive activities where you have material participation can offset ordinary income. Passive activities can only offset passive income, unless special exceptions apply. So, how do you determine if you materially participate? There are 7 IRS tests for material participation. So let's go through each one of them. The first test is the 500-hour test. So you participate in the activity for more than 500 hours. It doesn't matter how much anybody else puts in, but you have to track your own hours. So say you have a full-time office job, and then on the weekends you have a landscaping service that you work for more than 500 hours throughout the year. This will qualify for material participation. The second test is called the substantially all participation test. If you do most of the work, income or loss will be non-passive. If anyone else is involved, you will probably not satisfy this test. There is no specific number of hours associated with this test. So if in your landscaping business you are the only one working, then you should qualify under this test. The third test, this is the 100-hour test. If you participate in the activity for more than 100 hours and more than anyone else, then you should qualify for material participation. Now, this means that you have to track not only your hours, but anybody else's hours that is involved in that project. This also means that if there are more than one owner, then it's likely that you will not qualify, or that only one person can qualify. Now, this typically is the test that you have to satisfy in order to qualify for the short-term rental loophole. The fourth test is the significant participation activity test. If you significantly participated in any trade or business for more than 100 hours and your total participation for each of the activities that you work in is more than 500 hours, then you will satisfy this test. So if you have a restaurant business and you have a shoe store, then you work 400 hours in the restaurant and 150 hours in the shoe store, and then your total hours equals 550, which is more than 500, and this qualifies you to be materially participating. Now, the fifth test is the 5 of 10 years test. So if you could have been treated in any of the 5 of the last 10 years as materially participating, then you also satisfy this test. So number 6 is the personal service activity test. If you materially participated in a personal service activity for any of the 3 prior tax years, then you will qualify. A personal service activity involves the performance of personal services. So you could have health, law, engineering, architecture, accounting, actuarial science, performing arts, and consulting, among others, anything that you're personally performing that service for. So the 7th and final test is the facts and circumstances test. Instead of counting your hours or hitting a strict number, the IRS looks at the overall picture of your involvement and asks, were you involved in this activity in a regular, ongoing, and meaningful way? In other words, even if you didn't hit 500 hours, and even if you didn't do all the work, the IRS wants to know, were you one of the key people in running that activity? But you need to have worked more than 100 hours. Of these tests, really it's the first 3 that are going to apply towards a rental activity. But you only have to hit one of these tests, like just one that fits your situation. Now, these tests can be so confusing, so please talk to your tax advisor. Now, the 100-hour test typically applies to the short-term rental loophole. The 500 hours or more is part of the qualification for the real estate professional status, which we'll be covering in our next video. Now, what hours actually count toward the material participation hours? Ask this question. Is what you're doing impacting the day-to-day operations of this activity? So let's first talk about what doesn't count. What doesn't count would be investor type activities like reviewing financials, bookkeeping, paying bills, taxes, that kind of stuff. Or education and research hours where you're attending conferences or doing consultations or just reading books about the topic. And anything that's work not ordinarily done by an owner. Travel time also usually doesn't count. It does depend on the situation. Here are some examples of hours that do count. It could be cleaning, guest tenant eviction, improvements and repairs, maintenance, lawn care, marketing and advertising, photography or videography, platform management, property management, purchasing furniture and equipment, purchasing supplies, and tenant communication. So what about your spouse? Your participation in an activity includes your spouse's participation. And this applies even if your spouse didn't own any interest in the activity and even if you did not file a joint return. So the last thing we're going to talk about here is how to track your material participation. Your number one defense in an IRS audit will be your reasonable substantiation time log. This burden of proof falls on you. If you don't have adequate proof, then you did not materially participate. You can use any reasonable means of tracking your hours. Appointment books, calendars, narrative summaries like a journal, or online apps. Time logs should be done in real time, and to support your time even more, attach receipts. Material participation is probably the most confusing and misunderstood concept when it comes to real estate investing and taxes. And it is one of the most important when it comes to being able to take those big deductions on your tax return. You'll find the link below to get access to a checklist on what does and doesn't count towards material participation hours. If you haven't already, check out my Zero Tax Blueprint video for an overview on other topics in this area.